Hey everyone, it is Thursday, the 15th of August, and we have been having some amazing things going on in markets, a lot of motion, a lot of volatility. Um, and so I want to get straight into it today. Top three things that I'm going to talk about today are, first of all, alarm bells. They are ringing all over the world, and I'll explain a bit more about that. The second thing I want to talk about today is cash and being in cash. And then it's actually okay to be in cash, and just talk briefly about that. And finally, I'm just going to go probably a little bit more in detail into the current investment approach and what I'm looking to do with your capital. It's the same thing I'm doing with my capital and my investment strategy. So just before I jump into that, once again, I just want to say thank you to all of you who are referring clients to me and passing details through. It's just so humbling that you're doing that, and I really do appreciate it. The second thing I want to say is that please do check in with anyone that might be struggling or you think might be struggling. Things are not great out there, and I know financial stress is very often one of the leading causes of personal stress and family stress and relationship stress and all that other stuff. So it definitely ranks up there as a reason to be stressed. And finally, for anyone who has not had the opportunity to give me a review on Advisor Ratings, you can find that Advisor Ratings link somewhere in my email footer and probably somewhere in this video link as well. Jump on there. It would be, again, I'm very humbled by the kind things people are saying on my Advisor Ratings page. So with that said, let's jump into item number one, which is alarm bells. Now, first of all, I'm going to get into this whole China trade thing and Trump tweets and all this stuff. But what is currently causing this volatility in markets is we're getting whipsawed by two things. First of all, and as you all know, I've been saying this now for a number of weeks and probably months now, is the way I view the world is through the data. What is the data telling us about global growth, global interest rates, and inflation? And right now, there are alarm bells ringing. There are alarm bells ringing in China. There are alarm bells ringing in Europe. There are alarm bells ringing in the U.S. Now, China in particular has got a number of issues that they have to deal with in terms of managing their economy. And effectively what they're doing right now is they're trying to manage a slowdown in their economy to ensure that it doesn't crash, that it doesn't blow up on them. Whether they're capable of doing that, is another matter. Time will tell. But that's what they're going through. And what that sort of looks like is they're tightening up credit. They're restricting capital outflows. They're just doing a number of things that are deflating their economy. Now, this is not a good thing because it obviously they are probably the second largest, maybe the largest, but certainly the second largest economy in the world. And it's going to have flow-on effects elsewhere in the world. This is why we've seen export data out of places like Singapore and Hong Kong, and machine orders out of Japan. All of these things just dropping precipitously, and year over year and quarter over quarter numbers deteriorating badly. But they are not stabilizing at the moment. They have not stabilized yet, really, their economy. And that's why we're continuing to see volatility in the Asian markets, including ours. So the Shanghai Composite, I don't know what it's down year to date, but it's gotten just absolutely body bagged this year. I think it's down about a little over 20% or something like that. Might even be more. But just horrendous numbers. I haven't put charts up. I'm not going to do that today, but I have put charts up with Shanghai and Hong Kong and the Kospi and some of those indexes. And all you can see is left to right is just a clear downtrend. They're in bear markets. They are clearly declining. Lower highs, lower lows. It's just a bad situation. This is now infecting Europe. Now, Europe was already slowing anyway, but the data points that we've just recently seen out of Germany in particular, and Germany would be the strongest economy in Europe by a country mile, they're having trouble now. They're having problems, and their economy's not looking that great. So, so goes Germany, so goes Europe. really is probably the best way to put it. And Germany ain't doing so good. Sorry for the bad English there, but they're just not doing that well. So we have an issue there. And now this week, we've seen in the U.S., all of a sudden, everybody is going, holy moly, we have a potential recession coming, right? And a lot of the headlines now, a lot of the macro headlines are discussing this potential recession. Now, even if we don't get to a recession, you don't actually have to have a recession in order to have a really bad economic condition. So they can deteriorate to the point, and you can have year-over-year declines in all sorts of economic metrics, which are signaling slowing growth, which are signaling problems around the world without actually technically getting a recession. So don't get too hung up if you're paying any attention to the financial media. And if I was you and you didn't have to do it for a living like I do, I wouldn't, because it's just emotive headline to emotive headline trying to, get eyeballs on their websites. So they have to be very dramatic and very headline driven. But the reality is that the United States and people in the U.S. now are realizing that growth is horrendous around the world and it's beginning to affect the U.S. So this is now playing out in the bond market. You're now seeing, which in the U.S. bond market, which is interest rates continue to fall. So I've said it before. I'll just reiterate it and remind you that as bond prices rise, the interest rate falls, and that's one of the mechanisms that the Fed uses to control interest rates. But bond prices are going up, and that's why interest rates are dropping. And we saw this week a fairly significant spike downward in, I believe it's the 2-year Treasury bill in the U.S., Treasury note rather in the U.S. This is signaling that market participants are very concerned about continued growth, and it's sort of a recognition that the Fed is going to have to react at some point and continue to lower interest rates. So that's really what that's ultimately signaling, is that interest rates should continue to fall. So that's really all I want to say about global growth. And I've been saying it for a while now that the numbers don't look great and that it's deteriorating. And all of this volatility that we're seeing right now is now sort of coming to a head where I think you're going to see more and more investors heading for the exits. We'll continue to see these spike up days where we might get a 1 or 2% gain. And then, overnight last night, I think we had about a 3%, 2.5%, 3% downdraft in the U.S. markets, in the Dow and in the NASDAQ. And today, I think the ASX is responding. I think it's down about a little over 2 or a little under 2%, something like that. So all of this stuff leads me into my second point, which is that cash is okay. And I've had any number of conversations with many of you over the years about holding cash. And oftentimes a phone call or the conversation goes something like, hi, PJ, how's it going? Yep, great. When are we going to invest this cash? And I always sort of chuckle about that because I get that, cash is a very low yielding play. So if it just sits in the brokerage account in cash, it's going to earn very little. If it's sitting in a bank account in cash, it's going to earn maybe a 30 to 50 basis points more. But the point of holding cash really is this. Cash is firepower. First of all, if you're in cash, then by default, your capital, you can't lose any money, right? You can't lose capital if it's sitting in cash. Your purchasing power can be eroded by inflation, but that takes a longer time. But in the short term, of course, if you're sitting in cash, you're not going to see any capital drawdown in your account. And that's a very powerful position because right now, of course, we're seeing the markets getting slapped upside the head with volatility and movement. And I can tell you now, people who are sitting in managed funds, Aussie equity stuff, all these long-only funds, they're getting smacked and will probably continue to do so. People that are holding global equities are getting smacked. And I'm sort of saying that broadly, and I'm going to go into this in a bit more detail in my investment when I talk about the investment approach. But people that are, say, sitting in industry funds and these sorts of things, right now their performance is probably negative for the year. And if not, it's pretty darn close. So sitting in cash, you'll probably find that over the short term, you might even outperform the market. But please do not get concerned that I am sitting or holding a larger amount of cash. there are always going to be opportunities in markets. I'm going to talk about that in 1 second. There are always going to be opportunities in markets. And in order to take advantage of them, you must have cash. It's just that simple. So maybe just think of cash this way. It's just a position. It's just, I happen to be 50, 60, 80, 100%. None of you are 100% cash, but a very large portion of my portfolio in cash. That's fine. That's a position. It's capital protected. You're going to get a rate of return on that. And of course, you're not losing any money sitting in cash. So that segues into the investment approach that I've got currently. Many of you know, and we're rolling this out as quickly as we can. We're getting our interactive brokerage accounts set up. And just a couple quick things on that that I want to tell you. First of all, I have virtually eliminated brokerage costs. Now, what that means is, and just to put this into context, for those of you who have traded with me or who've invested with me for a while, you know that we've been using Macquarie Desktop. A trade will typically cost $20 minimum. That's up to about a $20,000 value of trade. And above that, it's a percentage of the amount. So it could, if it's a large position, $100,000, $200,000 trade I'm making, that could be a $300, $400, $500, $600 brokerage fee. And the reality is, it costs these guys nothing really to do these trades. I do not put any markup or anything on any of the brokerage costs, by the way. But in using interactive brokers, because I'm a fee-for-service advisor, I do not pass on or put any additional brokerage fee onto the interactive brokers platform. So effectively, all you're being charged is whatever they charge, which is nominal. I've been testing it, and I've been doing some trades in my self-managed super fund, and I'm paying like, $1 or $2 US for trades. So the first thing about this is, when you're investing in, and if you're in an actively managed scenario, which is what I'm going to be doing now for my clients, even more so than what I've done in the past, is the brokerage costs, the transaction costs are often the things that erode some of the return. So as I say, I've virtually eliminated the brokerage costs. So that's a massive, massive benefit to you and a huge bonus to you guys. The second thing is that, and I've said it before, but I'll reiterate it. It doesn't matter what's going on broadly in the market. So when you see the Dow or the Russell or any of these big indexes that are going down, and they're down 15, 20%, whatever, that's just a representation of the market as a whole. There are invariably going to be components of the market that perform positively when the broad market's going down. And likewise, when the broad market's going up, there are sectors of the market, is probably the best term to use, sectors of the market that are not going to perform well or be going down. The trick, and I've talked about this quite a bit recently, the trick is in positioning in the asset and sub-sectors of the market that perform in a certain way depending upon the growth, inflation, and interest rate environment and outlook. And so what that looks like right now is it's sort of a defensive investment strategy. So holding things like gold and gold proxies, housing and housing proxies, bonds, as in government bonds, and government bond proxies. So proxy is just another way of saying things that investments that behave like that thing, or have the same characteristics of that thing. And there's a number of things that we can own and invest in. And as soon as your interactive broker account is set up, I will be placing trades to establish positions in those things. So what that means is, and what I'm aiming for over the medium and long term for all of my clients, is that we'll actually be fully invested all the time, but we'll be fully invested in the things that are going to perform or have the probability to perform the best in that economic environment. I hope that makes sense. Maybe rewind that statement and listen to it again, because it's really important that you understand, as a client of mine, as someone who is trusting me with your capital and your cash, that I'm not just like one of these managed funds, say an Aussie equity fund, that has to be 90% invested all the time. Regardless of if the market is crashing, they have to be invested 90% because their fund mandate says they have to be. I have the benefit, and you have now the benefit of not having to do that or succumb to that investment style and philosophy. You have the capability, because of the advice and the way I'm managing your money, to be in cash 100% if that's what the situation calls for, or to reposition your asset base to be invested in those things that I've just described, those things that are going to perform well for the market environment. So a great example of that right now would be financials, Australian financials. Australian financial companies, and I'm talking banks, some of the brokers, some of the financial services, big consolidated financial services businesses, they're going to get hosed over the course of the next year as the earnings deteriorate. In the case of banks, as net interest margin drops, as interest rates continue to drop, that hurts their business. They're also fighting against, a royal commission and stuff like that, but it's really that their underlying business, which is lending money, that suffers in a poor economic environment. So probably over the course of the next year or so, we're going to see financial earnings comparisons quarter over quarter doing really poorly. So I would not want to own any Australian bank right at this moment of time. There will come a point where I'll probably pile into that stuff and say, boom, the interest rates are rising, the economy's growing, inflation is stable or slightly up, and all of those conditions are going to mean we invest heavily in financials. But we're not doing that right now. And what I'm trying to say is that if you owned, I can't even think of a name right now, but if you owned an Aussie equity fund, let's say Perpetual, I think they've got a long-only Aussie equity fund. Right now, you are set up to fail because a majority of what they own in their top 10 asset allocations are going to be, guess what? Banks, the Rios, the BHPs, and all the big companies in Australia that are in the top, probably 25 ASX. Those are the types of businesses that are going to be under a lot of pressure to have earnings performance and to have stock price performance over the next 12 months. So I hope that that little rant and ramble makes some sense to you. And what I want you to start to do, please, as a client of mine, is to think in terms of ensuring that I have you fully invested, but making sure that we're investing in and that you understand why I'm investing in the asset classes that are set up to perform well for the economic environment that we're in. I think that's about as simple as I can sort of explain it. That's really it for today's update. I'm very excited about a couple of things. I'm excited about Interactive Brokers. I'm excited about what's going on in the market because every crisis situation, every volatile situation that we see in markets creates a lot of opportunity. And I am getting better and better every day because I devote, most of my waking hours to understanding this stuff and to really being on top of it. I am honing my skill set so that I can surgically place capital into markets and asset classes and I can't make any promises. I'm not saying that they're going to perform better than everything else, but the probability, and everything that I do now is really based on maths, right? I want a high probability of success, investment success. And so I've got now the approach that is going to give me, and by default you, that sort of opportunity. So if you do have any questions about any of this, please leave a comment, give me a call, whatever the case may be. I really want you to understand all of this stuff. Hopefully you do, because I'm doing a good job of explaining in these videos. But if you have any concerns or you're unsure about what I'm talking about, please let's schedule a call and let's go through it. Finally, just to hit on a couple of news items. As you can see on your screen right now, Asia stocks, I've already mentioned it, getting slammed, this whole recession thing. There's been a yield curve inversion, which basically means shorter term debt is yielding more than longer term debt, and that's usually a very bad sign because again it is almost always preceded recessions. But again, as I said earlier, we don't necessarily have to have a recession. And of course, our favorite free world leader in the U.S., Donald Trump, is ripping into the Fed. I just find these headlines amazing that he's saying that Jay Powell is clueless. I mean, this is the guy that he put into the Federal Reserve, who runs the most powerful, well, arguably the most powerful central bank in the world, and he's calling him clueless. I mean, it's just astounding the level at which they will go to cajole and to bully people into doing something. And ultimately, what this is all about is it's about the economy. And Trump knows that to be reelected, he's going to have to show that he has been a better steward of the economy, and certainly not have the U.S. going into a recession or anything of that nature. And what Trump knows is that by lowering interest rates, that should alleviate the issue, at least in the short term, so that he can get reelected. So that's kind of what that's all about. Anyway, I hope you have a great weekend, and I will look forward to further catch-ups and, of course, to getting all the Interactive Brokers accounts rolled out. I hope you do have a good weekend, and we'll chat again next week. Take care.